Hello and welcome to Martyn Lucas Investor. My name is Sensei and you're watching the Morning Forecast Show live every single trading morning, 2 hours before the opening bell, 1 hour before Martyn comes live. Let's get straight into today's story, which is all about big tech and the AI bleed. So let's get straight into that. If you have just tuned in, please do hit the like button. Please do subscribe. If you haven't checked out the newsletter yet, there is a free trial. I'll give you the link right now in the chat. I'll also pin it as well. So let me do that. Perfect. I hope everyone enjoyed their long weekend, President's Day. We weren't live yesterday. I think Martyn was live. I wasn't live yesterday. It was a US bank holiday, and I was putting out a few newsletters for you yesterday. I hope everyone got their calendar. I hope everyone got the XRP Weekly, as well as the portfolio challenge that went out on Sunday, I believe. Yes, Sunday at 8 p.m. in the UK. I think it was 3 p.m. in the US. I hope everyone got that. That was the second iteration of what I was buying in the portfolio challenge. Okay. Just want to make sure we're running okay. Let me check all the comments. Good morning, Human Being Liz is here. Robert Elliott is here. Henrik is here. Brilliant. Jack is here. Yes, everyone is in the show. If you have tuned into the show, please do hit the like button and subscribe if you haven't done so already. Okay, the top stories today are sterling slips on UK jobless data. So we've got a massive unemployment not massive unemployment, but it wasn't what was expected. 5.1% was what's expected. We got 5.2%. It's pretty bad numbers. I think the worst since 2021. So 5.2% unemployment numbers hit this morning. A few hours ago in the UK, we got those numbers. Obviously, the FTSE 100 rallied on that. Why would it rally? Well, because it means that the Bank of England has to start cutting rates. If we go over to the FTSE over here, you can see the FTSE's up. It was up a little bit more earlier, but now it's up 0.4% after getting that bad news on unemployment. So bad news is good news. We spoke about that before. But yeah, that bad news is good news narrative is still out there. We've got the dollar climbing. The pound came down on that. Amid AI sector volatility. We've got an oil blockade in Cuba, corporate price hike. So this is where we're starting to worry about inflation in the US, because we're starting to see potentially more inflation in relation to goods, because the companies are now passing that on to consumer. So in the next 3 to 6 months, what we need to keep our eye on is inflation in the US. Pentagon clashes with Anthropic over ethics, which is obviously a major story as well, all in the newsletter. But the main one we're going to be focusing on is AI spending hitting a wall? We will be turning it into a video, so don't get confused when I introduce it as a video. If you're watching live, this is live, but I will be turning this into a video as well. If everyone could please take a second to hit that like button and let everyone know we are live, and please do subscribe if you haven't done so already. Okay, let me welcome everyone into the show, and then we'll go into the AI story. Mickey is here, Nonny's here, David's here, Yolanda's here. Hello. Jack is here. The damn dentist is here. Lovely to have the damn dentist here. Mikey is here. Mikey Six Strings, good afternoon. Lovely to have you here, Mikey, with us. Okay. Let me just check if that's working. Okay. I wonder if my chair's come down slightly. I think that's what the problem was. There we go. Okay. Let's start this video. We're going to do it all on the AI bubble. It's going to be a really important video. So let me scroll down over here and start with it. Breaking news on Martyn Lucas Investor. We are looking at the AI bubble. Is it breaking? Well, we've got some information, we've got some evidence, we've got the charts, everything you need to know about 2026, my plan, the facts, the fiction, what we need to be worried about. 600,000 jobs just eroded in 2025, which we didn't know about. We've just figured it out now. We've got recession indicators. We've got AI spending bubbles. Let's get into it. It's from our very own newsletter. If you do want to keep up to date with the news every single day, 2 hours before the opening bell, we release this information. Plus, you get the portfolio challenge, the chart training course, all of that sort of stuff is in the description. There's a 1-week free trial. I'll leave the link down below. But here is the story today. The 600 billion question: is AI spending about to hit a wall? Big tech is on track to spend between $630 billion and $680 billion on AI infrastructure this year. Amazon alone plans to spend $200 billion. Alphabet, Google is committing up to $185 billion. Meta up to $135 billion. Microsoft around $150 billion. To put that in context, the combined spend rivals the GDP of the whole of Sweden. So we're not talking small amounts of money. This is the most sort of amount of investment we've seen in decades. Before this, we would have to go back to sort of the railroads when that was being built. But yeah, massive numbers here, bigger than the GDP of Sweden. What does that all mean though? So if we're looking at the market as well, and we start looking at where the FTSE is, where the S&P 500 is, we are now looking potentially, technically looking like we are topping out. We failed to break 7,000, which is a major level on the S&P 500 3 times. We're back below the support of 6,800. People are calling this as a topping out structure, bearish divergence. You're seeing all of these slightly higher highs, but then when you look at the RSI, if we get the RSI on the screen, you can see the RSI is actually forming lower highs. So it is exhaustion by the bulls, meaning that the price is going higher, but the momentum is not going any higher, and the momentum is fading. So that is a concern we're seeing. So the S&P 500 hit 7,000 on January the 28th, but now it's pulled back to about 6,800 by mid-Feb. 8 out of the 11 sectors are actually in the red. Microsoft has had a big fall from $480 down to $400. Nvidia is well off its highs at $180. The Nasdaq is down over 4% from early February, so only in the last couple of weeks. And the big tech has shed a combined 1.3 trillion in market value since late January. So over the last 10 days, the big tech has taken away 1.3 trillion in market value, which is massive. Obviously, something is shifting, and the key questions for 2026 is whether all that spending will actually earn its keep. I've told you slightly my thoughts before. I've told you that I think AI is going to revolutionize the world. I've told you that there's going to be a time before AI, a time after AI. I want to be invested in AI. We have been invested in AI for the last few years, and I want to continue being invested in AI. But I've also said that there can be cracks forming. There can be better levels we can buy into some of these AI stocks, even though I am bullish on AI as a whole. So there are cracks starting to form, and it's more about sentiment. Once the retail and the hedge funds play on the retail side, when they start selling off just because they see the emotions of the broader market. So once there starts to be forming some of these cracks and the media takes hold of the cracks of AI, people start selling, hedge funds, investment management firms start going short. We start seeing maybe a 20, 30, 40% correction. That's actually not as valid as it might seem. So I don't think this is an AI bubble in the sense of the 2000 .com era, because those companies weren't actually generating any money. There is a lot of AI companies not generating money, but the Mag 7, which is what's taking us up, is generating money. It's just, are they getting their return on investment? So let's continue with the story. I'm going to talk about crypto. I'm going to talk about Bitcoin. I'm going to talk to you about my strategy, what I'm buying, and what will actually benefit from this. So stay tuned with me. If you are enjoying the video so far, please do hit that like button. Subscribe if you haven't done so already. This is taken from our newsletter, so check it out. First link in the description. There is a free plan. There is a free trial. There's a plan for everyone, so make sure you check it out. Okay, so let's continue. The AI reality check. Most of this money hasn't produced matching revenue yet. An MIT study found that 95% of enterprise AI pilots failed to reach production. S&P Global reports 42% of corporate AI initiatives were scrapped in 2025, up from 17% the year before. Forrester found that 55% of companies that cut staff for AI now regret it. And Granta predicts half will rehire within 2 years. Klarna, the postal child for AI driven layoffs, replaced 700 workers with AI, watched quality collapse, and quietly brought humans back. Interesting. Here's another problem, the power grid, and I'll come on to the power grid and utilities and how I'm playing that as well. But the power grid can't keep up either. Morgan Stanley projects a 44 gigawatt shortfall for US data centers through 2028. Bain and Company calculates that AI needs 2 trillion in annual revenue by 2030 just to justify the infrastructure being built today. So that's just to break even. And obviously, that's not what the market's pricing in. So here's the important nuance, AI is not going away. I want to make this clear. I was 2 years ago, 3 years ago, once we saw how revolutionary AI was, this was a game changer. Not even probably 5 years ago now, but it is going to change the world. It is going to be implemented in your life, whether you like it, whether you don't like it. It is going to change the way companies operate. It is going to change the way we look at earnings. It is going to change the way we look at how investments are made. So don't sleep on it, but also be aware to it. Be aware of it. So AI is not going away. This technology will define a generation. There will be a time before AI and a time after AI, and we are at the inflection point right now. The companies that cracked the monetization problem will be amongst the most valuable businesses in history. You don't want to miss out on the AI train. You don't want to be that person calling for the whole thing to bust every other day and just watch it get away from you. You do not want to be completely outside of this trade when it happens. The question is timing and price, not whether AI matters. Let's look at some of these winners and losers off the Mag 7, and then I'll come on to my strategy in a second. Here are some of the big names. So the market is no longer treating all AI spenders equally. We're starting to see a divide. We're seeing Alphabet, which is holding up pretty well with its cloud revenue, and its backlog doubled to 240 billion. We've got Meta, which is outperforming. The AI-powered ads push annual revenue past 200 billion, stock surging 10%. We've got Microsoft, unfortunately, is not performing as well, especially due to some of the way they're pricing their products. So only 15 million paid Copilot users. That's a very small amount of the main AI space. And we've seen the Azure growth also slowing. Amazon is currently under pressure as well because of how much they are investing, and we're not seeing a return, or investors are not seeing a return. So Alphabet and Meta currently, again, this changes every quarter, but we're starting to see a shift now, but to more of a long-term understanding of where these stocks are going. But Alphabet and Meta are can point to clear growing revenue from AI. Microsoft, sorry, Alphabet and Meta can point to clear growing revenue from AI. Microsoft and Amazon are spending aggressively but struggling to show where returns are. And the investors are noticing. That's why we're seeing Alphabet and Meta potentially hold up a bit better and go up a bit more. And Microsoft now, if we look at Microsoft's chart, you can actually see how big of a pullback it's had. Microsoft, if we look at Microsoft's chart quickly, you can see how we had a double top. Again, that double top was identified on our charts. But if we forget about the double top, since that level, we're down 28% on Microsoft in the last 120 days. So we're starting to see some of the clear winners and potentially some of the losers. I don't think Microsoft is going to go anywhere in the future, and it's potentially coming into a zone where it might be interesting to buy it. But you can see how the market is punishing the ones that aren't benefiting from AI, but it's rewarding the ones like Google. Obviously, everything's had a slight pullback recently, but if you look at Google, you can see how different that chart is. Google is up. We look at the chart since April of 2025, even to levels we're at now, 120%. If we go to the highs, 150%. Google, of course, all of these can fall if we do start changing narrative, and Google will have a long way to fall if we do have a changing narrative. Google can fall as much as 30% if we're if the sentiment changes and this AI burst occurs. Again, when I say AI bust, I'm not calling it a dot-com era. correction. I'm calling it a different situation where we get a downtrend mainly based off sentiment and emotions. But anyway, let's go back to so you can see the winners: Google, Meta emerging, and the losers potentially Microsoft and Amazon. If we have a quick look at Amazon's chart as well, and then we'll continue with the story. Um, Amazon is currently, yeah, you can see how this is also down a fair amount from its highs. Amazon is down 23% in the last 110 days. So you can see the winners and the losers emerging. The risk that nobody is talking about enough. Of course, there's actually other issues in the market right now. And that's why when I come onto my investment strategy right now in my portfolio and the portfolio challenge, you will understand why I'm positioning the way I am. So the risks that nobody is talking about are beyond AI, there's two structural risks that deserve more attention right now. We've got sticky inflation and the stagflation trap. So the Fed itself has flagged stagflation as its biggest concern for 2026. Remember, if we have stagflation that has major effects on the economy, it means the Fed won't be cutting rates. It means they might actually raise rates. Anyway, core inflation sits above the 2% target. ISM services prices hit 66.6%, which signals that cost pressures in the services sector aren't easing. At the same time, unemployment is creeping higher. Revised data showed that only 181,000 jobs were actually added in all of 2025, roughly 900,000 fewer than initially reported. So this is what's happening behind the scenes. Every time we get these jobs reports that we cover live on the show, we see the number reported, the market reacts, whether it's lower or higher, whether the market goes higher or lower, based off those jobs numbers that actually come out. But secretly, behind the scenes, we're starting to see that all of these numbers are essentially wrong and that they get revised later on. But the market doesn't react as much to the revisions as it does when the initial numbers drop. And at some point, we do need to react to those numbers being revised. So 900,000 fewer jobs than initially reported in 2025. That is a crazy number. That means we've got unemployment creeping higher than we accounted for at the time. RBC Capital Markets see core inflation potentially reaching 3.5% by mid-year. And remember, the issue of unemployment and inflation is looking, again, the concern for 2026 is inflation is looking to be pretty stagnant. Again, we've got CPI a little bit lower. The market rallied on it, but that was a very small data point. We've got PC later this week, which make sure you're subscribed and you can see what the Fed's preferred inflation report says. But we've got inflation pretty stagnant. There's not enough evidence to say it's coming down and down and down. It looks like it might stagnate at these levels, especially with the tariffs and the studies that show that the pass through is going to continue at least to be not to potentially take it higher, but to keep it around 2.5, 2.6, 2.7%. And then unemployment going up, that means the Fed needs to cut rates. But if inflation's staying stagnant, then they won't cut rates. So then you get into a really sticky situation. And that's what we're worried about in 2026. So consumer confidence has plunged to its lowest since 2014. Credit card delinquencies are at their highest in nearly a decade. The Fed is stuck. Cut rates and risk fueling inflation, or hold and risk tipping the economy into recession. There is no easy path. And one of those paths is a recession in 2026, and we'll come on to that and some of the firms predicting a recession. We've also got the issue of the yen carry trade. Bank of America, is it Bank of America, BCA? Anyway, BCA research called the yen carry trade a ticking time bomb on February the 11th. Apollo's Torsten Slock flagged similar concerns. Morningstar's chief US strategist David warned that it can threaten both US stocks and bonds. The trade works by borrowing cheap yen and investing in high-yielding assets elsewhere. It unwinds when the yen strengthens or risk assets fall. And we've got the yen strengthening and risk assets falling. And when it unwinds, it does not stay contained to the currency markets. That's a mistake that many people make. It spills into equities, bonds, and leverage investors are forced to sell across the globe. With the Bank of Japan signaling further rate hikes, we already know that. We've covered the Bank of Japan reports, and we will continue to do that live on the channel. They've said that they're going to have future rate hikes maybe as soon as April, which the market isn't pricing in. If that happens, while the bonds are heading higher, that is a condition for the unwind to occur. We've seen it happen in 2008. We saw it in 2015, um, um, 2024 as well. All were sharp sell-offs, and especially now we're looking to see the full unwind happen potentially this year. All the other ones were partial unwinds. Now we come on to the recession question, which if you look at this chart we have here, we're looking at different banks and analysts and their probabilities. So we've got Goldman Sachs at a 20% probability. Polymarket, which is obviously where you can look for different odds, is putting it at 26%. The New York Fed is looking at 27% if you're looking at the yield curve. RSM is saying 30%. JP Morgan is saying 35%. And BCA Research is saying 75% plus. So the market hasn't priced a recession in. It's priced a 20%, 25% chance of recession occurring. So if a recession does occur, we can see a surprise in the market. And not only if a recession occurs, if people start talking about recession and if the media starts covering recession more and more, because it's not priced into a great extent in the markets, we can even have a sell-off without a recession because people are worried about a recession. Right now, people aren't worried about recession because the likelihood is low. But if we start seeing, because of all the things we've discussed, the likelihood of a recession going up, then we start seeing the media cover it. Then we start seeing a panic in the markets. And then whether or not we get a recession doesn't actually matter because we've probably already had the sell-off. The hard data looks reasonable. Manufacturing PMI hit 52.6 in January, the first expansion in the year, but the soft data is flashing red across the board. Consumer confidence, credit quality, and labor markets revisions all tell a more cautious story. The truth is probably somewhere in the middle, but the range of outcomes is unusually wide, and that uncertainty itself is a risk. Let's have a look at the clock, the Merrill Lynch Investment Clock as well, and then we'll come on to the my portfolio challenge and how I'm positioning. So what I'm actually going to do is I'm going to split this up into two parts. So if you've stayed with me till the end, I'm going to give you the link to the next video, which is going to be right up here. So go check that out. There'll be another playlist up here. If you want to get the newsletter, there'll be a link for it over here. And come on to section 2 where we start talking about the investment clock, where I'm positioning my money, and a few more charts. But until next time, take care of yourselves and each other. Okay, we're going to come on to part 2 now. If you are watching live, stay with me. You get to watch the videos be created, so you've got the front row seat. Please do hit the like button if you're watching live. Check out the newsletter. I'll put the link in the live chat as well if you haven't got it. Let's see who's in the chat. Good day to all. Chris Investment is here. Clay Scott is here. Human Being Liz is here. Nick Jones is here. I'll answer everyone's questions when this video ends. The Fed is buying T-bills this week. That would give us a nice liquidity boost, says Vocal Foster. Yes, but it's not large amounts at this point in time. Okay. Where were we on the video? Breaking news on Martyn Lucas Investor. We're looking at the AI bubble burst. Plus, where can we benefit? Is it utilities, energy, AI stocks? Where am I putting my money? Well, here is the Merrill Lynch Investment Clock, and that's where we're coming to. If you haven't watched part 1 of this video, we actually discussed the whole recession odds. We looked at a few charts. So go check it out. First link in the description. And then now we're on this. Where are we on the clock? So one of the most useful frameworks for thinking about where to put your money is the Merrill Lynch Investment Clock. It maps the economic cycle into 4 phases: recovery, boom, slowdown, and recession. And it shows which asset classes and sectors historically perform best at each one. So where are we right now? We've had a boom and we're late cycle. So we've seen commodities boom. We've seen overseas equities. Remember, money moved out of the US. We're now looking at overseas equities booming. We're now looking at inflation-protected bonds and large cap. We're at the end of the boom phase. We're heading into the slowdown, where the clock suggests short-term treasuries, defense sectors, high-quality assets, And then towards the end of that slowdown, growth stocks, long-term treasuries, potentially heading into a recession where you buy growth stocks, rate sensitive sectors, the lower caps, and then into the recovery. So where are we right now? I believe we're at the tipping point. We're basically in the slowdown because we've already had the equities boom, we've had the late cycle sectors boom, we've had large caps boom, we've had overseas equities boom. Now I believe we're in the slowdown. Where is the best place to put money? Defense sectors, areas which can survive a recession because that's the next point in the clock. So right now the data is pointing towards the slowdown phase. Growth is decelerating, inflation remains sticky, and the Fed is on hold. In this part of the cycle, the playbook favors defensive sectors, high quality assets, short term treasuries, and commodities that benefit from structural demand rather than speculation. So, if I go over to this for a second, I'll show you what I'm doing with my very own money inside the portfolio challenge. If we go over to sensei.news, you've got a heading over here that says portfolio challenge. You can see if we refresh this, oh, maybe I didn't tag it correctly, but you've got entry one, which is my full playbook, where I've put my money. And then again, we've done a whole newsletter on copper because that's going to help with um, the AI cycle and the data centers. I don't want to be investing in the AI stocks right now. I want to be investing in the utilities and what is needed to provide that the wires, the cables, the leveling up in electrification of the grid. And also, we just released one. I'm going to put it into the right section in a second. The defensive play, 14 holdings across healthcare. This week, I'll be looking at utilities, and next week, I'll be looking at consumer staples, getting prepared for potentially a recession, and worst case, building the backbones of this portfolio. If you want to see exactly what my holdings are and the full research, you can see how much research we put into every single one of these pieces. We look at the sectors, we look at the companies, we look at the numbers behind the companies. Remember, you can't just look at a company and just look at the financials. It doesn't make any sense. You have to look at it, comparing it to its peers in the specific subsector. Then we do the research on the companies, compare them. You can see how much research is in this. It is pages of research. And of course, you can skim through it. You can read specific parts that are interesting to you. I'm not telling you, this is never financial advice. This is just research I want to share with you because I want to share a journal of my portfolio. Then you can see the execution, where I'm putting my money, what holdings I'm putting, how much I'm putting in, and then you can see exactly. I'm using trade. Oh God, what am I doing? I'm using trading 212, and you can see all my holdings for each of these. Anyway, let's get back to it, and I'll come on to that in a second. If you do want to get that, plus all the other perks and benefits of the newsletter, which is the full daily newsletter every single trading morning, 2 hours before the opening bell, full news. You get the deep dive on the macro story or the crypto story. You get the chart of the day. You get an ad-free experience. You get event cheat sheets for FOMC, Bank of Japan interest rate hikes. Again, that's the big risk this year is the carry trade unwind. You get one-on-one DM access. You get access to community. You get access to every time I buy just randomly on my crypto portfolio as well. I tell you as well, that's not part of the portfolio challenge. The portfolio challenge is an ISA here in the UK. You can't really buy crypto on there. We will be buying crypto companies potentially in May and October when the secondary flush comes. You get the chart training course and all the other benefits. So first link in the description, there is a free plan, there is a free trial, and there is a monthly plan. There's a plan for everyone. First link in the description. So right now, the data is pointing to the shutdown phase. Growth is decelerating, inflation is remaining sticky, and the Fed is on hold. In this part of the cycle, the playbook favors defense sectors, high-quality assets, and short-term treasuries, and the commodities that benefit from structural demand rather than speculation. Copper. If the cycle continues to turn and we tip into recession territory, then that's when the clock shifts towards rate-sensitive sectors. So then we start looking at more interesting stocks. Potentially, we start looking at EV tolls. Vaz is going to help me do some research on that sector, and that's a pretty rate-sensitive sector. SBCE, some of these smaller companies that are very rate sensitive, if they survive the recession, that could be a great time to get in. Growth stocks as well, the big AI companies that might have had a big drawdown, They're growth stocks. They're going to last forever, and you will think they'll have a V-shaped recovery. So them as well. Long-term treasuries and corporate bonds. That phase is best entry points for risk assets tend to appear. Again, that's why I'm not all in. If you're all in and there's a recession or there's a carry trade unwind, you're going to be very annoyed you can't buy those prices, because those prices are once every 5 years you get an opportunity like that. Understanding where you are on the clock is the difference between chasing last year's winners and positioning for what comes next. So, how am I building my position? Well, I'm building the base. The market right now is uncertain. So, in a market this uncertain, there is always opportunities, but it matters where you look. Right now, I'm focused on building a defensive base for the portfolio. Healthcare, utilities, consumer staples, copper. These are sectors that tend to hold up well when volatility rises, inflation stays sticky, and economic growth slows. Healthcare benefits from aging demographics and non discretionary spending. So, this isn't something people want to spend money on, it's things that people have to spend money on. Utilities will benefit from the AI driven surge in energy demand. Data centers need power regardless whether AI monetization works out. Consumer staples provide steady cash flow because people keep buying essentials, and copper is the backbone of electrification, data centers build outs, and energy transition. Demand is structural, not speculative. And again, it's not just about what sectors; it's also about what companies within those sectors. So for copper, I've got a specific pie which is makes the most sense to me anyway. Same with healthcare. I'm not choosing just a random healthcare ETF. I'm not just choosing random healthcare companies. There's a specific way I've designed that portfolio. Again, same will be with consumer staples and utilities. Later in the year, if we get a secondary flush, which I expect we will, especially in crypto, whether it's from a recession scare, a carry trade unwind, a broader correction, or just technicals, that's when I'll start looking at higher beta opportunities. Crypto and crypto adjacent companies, innovative tech, and yes, AI stocks at a better price, because AI will change the world. The opportunity is generational, but you don't want to pay peak prices for a thesis that hasn't proven itself yet. So the goal is simple. I'm going to build the base now. I'm going to stay patient and be ready to rotate when the market gives me a better entry point. You never want to be fully out the market. I never advocate for anyone to day trade or be out the market or sit on a pile of cash and never get in, because that is probably a way you lose out. The best investors out there and the people that end up with the best retirements are the ones that just keep buying and holding and don't make any silly decisions. And they're always in the market, whether it's an upturn or a downturn. So you never want to be fully out the market, and I'm not. I'm in. I have a stock portfolio. I have a crypto portfolio. I just am a little bit bearish on this year, and I want to take the advantage of the lower prices, because the biggest moves often come when fear is at its highest. But you don't need to chase. Let the opportunities come to you. FOMO and emotions, and we've spoken about this a lot, is probably your worst enemy. Here are some of the things I'll be watching this year as well. On the 25th of February, next week, we've got Nvidia earnings. It is the single most important earnings event of the quarter. Consensus expects 65.5 billion in revenue. A beat validates the entire AI capex thesis. A miss could trigger a rethink across the whole sector, given that 1.3 trillion has already wiped off has already been wiped off big tech this year. The stakes could not be higher. So next week's Nvidia earnings is massive. We'll be covering it live on the show. So we have to keep an eye on that. That could be the earnings that triggers the downturn in the whole sector and the whole market, because AI is propping up the whole market as well. March the 6th, we've got US jobs report. March the 11th, we've got US CPI report. Later this week, actually, is a big report as well, PCE. And tomorrow, we've got Fed minutes. So Fed minutes is basically the behind the scenes of the previous FOMC. So we get to see exactly what the Fed's plan is. And I'll be covering that tomorrow. And then on Friday, we've got PCE, which is the Fed's preferred metric of inflation. Then we go into the FOMC meeting of March 17th to 18th, which we're not expecting a rate cut. And I'm pretty much 100% sure we won't get a rate cut. Some people are still expecting rate cuts, but it'll be important what Jerome Powell says. We've got the Bank of Japan policy meeting on March the 18th. Then we've got the next FOMC, which will be the second to last Powell FOMC. The Fed transition, which will be quite a big market event in May the 15th, and then the US midterm election. So a lot coming up this year. I'll give you all my thoughts as well. We're looking at Bitcoin. We are ranging right now. I think we'll go lower. So stay with us. I'll give you all the charts as we go on. Make sure you subscribe. Make sure you've got the newsletter, because the newsletter has all those charts, has all the analysis, has all the bits of news, my full portfolio challenge. We've just started it, so you're not late. So go and catch up with that. 2 videos up above. The newsletter link I'll put down here. There's a free plan, monthly plan, and an annual plan. And there's a free trial. So go check it out. But until next time, good luck to you all. Take care of yourselves and each other. Okay, let's go to your comments. Let me see if I can bring the comments over here for now. That's very small. Okay, let's see if this works. Yes. Okay, let me go into everyone's comments. Martyn will be live in about 10 minutes time. Why isn't... Oh, yeah, there we go. uh, shed says Nick Jones. Google is overpriced like a bag of potatoes, says as Zion Ryan. Google can drop a lot. I mean, all of these stocks can drop a lot. We are... I mean, if we let's look at some of these top AI stocks. So Amazon has already dropped, and it can go lower. It can come all the way down to its 200-week moving average if we do have a pretty big downfall. So the first level of support for Amazon. I mean, these are getting a bit more interesting as buys. Amazon is down another 4% to its level of support, and then its moving average is down 16%. If you look at Microsoft, that's already come down. So we just compare how much Amazon has come down and Microsoft. Google can do the same. Amazon's down 24%. Microsoft is down 28%. So if we go over to Google and just say it goes down as much as Microsoft and Amazon, and it doesn't and the correction doesn't affect it anymore. Let's just say it does the same as Microsoft and Amazon. 24. That would be another. That would be 260. So that would be another 260. That'd be another 16% drop in Google, and that would come down to our first level of support. But that would just be if Google just goes down and there's not really a massive news story. If we do get a recession, a carry trade, or an AI bust, for now, again, when I say AI bust, I'm not saying it's the same as a .com era. I'm just saying an emotional trade from people based off bad Nvidia earnings or whatever it might be, then I'll be interested in buying Google. Of course, I would be when it drops another sort of 46% or 20 to 23% from the levels we are at now. But that might never happen. We might never get that trade, but if we do, a company like Google is not going anywhere, so it'll be annoying not to be taking advantage of it. Let me go back to your comments. So Google is overpriced like a bag of potatoes. Was your comment? I think everything's overpriced. You can never get anything at value. Google is more overpriced than, let's say, Amazon, Meta, but is that because of their earnings? Maybe, probably. Google is, as I said in the report, has the best AI thesis right now. But the AI sector, the issue right now is people are starting to see that the whole AI sector is a bit overpriced, as it's not producing the amount of money they're putting in. They're not getting the return on the investment that investors were expecting. Dan Ackerman says the entire US economy will be in big trouble soon. Find out, I believe, 1929 style crash is loading, says Dan Ackerman. Human Being Lear says new entry chance in all that you show. CrowdStrike. CrowdStrike, SAP, and 2-3 more. And I don't even know Microsoft, I'm not sure. I think you mean CrowdStrike? Clay Scott says good morning. Chris Investment says good afternoon to you all. Let me bring that there. Human Being List says, yes, Dan, I agree. I did a research on the world ETFs. Nick Jones says, yes, to be honest, it's afternoon here. Just been a lazy morning. Yolanda says, let's hit the like button. Tidy Big Dog says, hello. Volker Foster says, the Fed is buying T-bills. Yes, we covered that. 1978, Buckley said, we've been in a rolling recession since the fall of 2021. We're heading towards depression. Bond markets are going to shatter soon. Thank you, 1978 Buckley. And that's why gold, silver, cash, treasuries is not a bad idea. Dan, there's a lot of different ways the market can come down, but there's also it can continue. Too many people call a crash years in advance and they miss out on gains as well. That's why I like to be. That's why I like to be prepared for the upside, the downside, and the sideways action. Sometimes I have a bit more of an inkling onto which side I think the market's going to go, and I position myself slightly more on that side. And for the last 6 months, it's been bearish on crypto, and now it's going to be bearish on the stock market. But I still want to be invested in the stock market, so that's why I'm building the base. Sent you a message on X. I just did a research link into Discord. Person of Palantir Epstein. You should too. Tank Palantir huge. Oh, thank you, Vocal Foster. Let me have a quick look. I don't normally check X. I normally keep all communications on Substack. The premium members can always message me. If you are a premium member of Substack, Vocal Foster, do send it to me there. I don't see anything. Although I don't really know how to. How do I check messages? Maybe it's message requests, but I can't see any message requests. Yeah, I can't see it. Maybe you sent it to the wrong person. Will crypto also dump because of the AI bubble? Yeah, I mean, if we do get a correction in the stock market, we will get a correction in the crypto market. But as I've said, the crypto market's already down. So normally, what you'll see is Bitcoin, crypto bottom out first, and then the stock market bottom out. So even though the stock market might go down 20%, the crypto market might only go down another 30, 40%. And that's, again, you might say, well, the crypto market's still going down more than the stock market. Yes, it is, but not to, normally if the stock market goes down 30%, you'll see the crypto market go down 70, 80%. But because the crypto market is already in a bear market, it's been in a bear market, we predict the bear market, and it's already down 80%, then when the stock market correction comes, it can be that final sort of capitulation on crypto, and crypto can have that aggressive bounce as it normally does, while the stock market takes a bit longer. So yes, it will, but not as bad as it would have if crypto was also at all-time highs. 1978 Buckley, true. If you combine 1929, 1987, 2000, 2008, that might be closer. If the stock market crashes, so will crypto. Yeah, yes, but I've just explained my thoughts on that. Yes, AI bubble is tech. Human Being Liz says, hello, Buckley. Good morning. We know that something big is coming, right? Big crash is looming. They always try to convince you things are great just before the worst happens. Yes, and we've got all sorts of analysts saying that the S&P 500 is going to go to 8,000 this year. It might do, maybe after the correction. 1978 Buckley. Yep, been watching it since 2007. Truth be told, we never came out of the last one in 2008. I mean, look at this. If we look at everything against money supply, if we're going to talk about this, let's go to S&P 500 divided by M2, which is the S&P 500, but in terms of the amount of money being printed. We're actually 2000, the stock market's gone sideways for 26 years. We're no better than we were in 2000. So right now, the stock market has actually gone, we're actually down in 20 years if you're looking at the amount of money being printed. So obviously that's not brilliant. If we do the same thing, obviously it's not something like Bitcoin is definitely out, but it's actually up. But the S&P 500, if you look at that chart there, that's the 2000 bubble right there, and we have still not actually exceeded the 2000 valuations if we divide the amount of money that's been printed. So we haven't really actually got anywhere in 26 years. But also, it is going to act as a big resistance. And last time we hit these levels, we went down 90%. So, are we in store for a massive correction as well? Well, that's a bit separate to what I've been talking about today. But at some point, are we going to get a correction like we've seen big corrections like 2008, 2000, 1929, or whatever? Maybe. But I'm not calling for that. That's something very hard to predict when that will happen. It'll probably be because of the debt ceiling and the debt crisis around the world. But that's a can that can be kicked down the road over and over again. Go back to your comments. Oh, that's not the right one. Here it is. Fed did this in 2024, 2025. Powell is disgusting. Actually, Jerome Powell's done a lot better than lots of other countries. Right now, inflation is down and unemployment is pretty steady. The concern is inflation is going to stay sticky, unemployment's going to go up. But right now, Jerome Powell's actually done a pretty good job. If you look at the UK or other economies, the UK has now got unemployment at 5.1% and sticky inflation. So Jerome Powell's done his job correctly. If he cut rates more, then we'll be in a bigger problem right now with inflation. So he does get a lot of stick, but I wouldn't blame this on Jerome Powell. Although they did print a lot of money in 2000 to 2020, so that could have caused it all. But then printing money helped the stock market. So there's all sorts of ways you can look at it. Hume Bigless says red here all in Europe and Asia. Is there a red day in the market? Let's look at the newsletter. We've got silver down 4%, gold down 2.5%, XRP down 2%, Bitcoin down 1%, Nasdaq down 1%, Ethereum down 1%, bonds strangely are also down. The S&P 500 down 0.5%. Yeah, this is not looking good in any market right now. I'm self-employed too. I feel it. Clone says, I think this is all a big manipulation. They need to reset the price of the markets because everything's expensive at the time, whether it is stocks, commodities, and cryptos. Dan Ackman says, I can see it clear as day, guys, in the same industry, and we're closing doors daily. Same here, Buckley. I'm not a doom and gloom. I just see the economy for what it is. I have been self-employed for 22 years, and the signs are just like 2008. Michael Burnett says people have been calling for a bubble burst for the last year. I haven't. I'm not even calling for a bubble burst, really. A bubble burst would be something similar to 2000. What I made clear today is I don't think it's the same situation as 2000. Anyway, S&P 500 index 2008 1,500, 2026 6,830 fully recovered. Eyes on the Strait of Hormuz, guys. I think things are looking very spicy after the round 2 talks with Iran. 2 more bomber planes have deployed to the region. I think the talks went well. Dan Ackman says stock market is an economy. That is very true. The stock market is not the economy. No offense, when the S&P is all-time highs, it's the time to be the most scared. But also, when the S&P is at the all-time highs, it's not the time to sell because historically, if you sell every time the stock market's at all-time highs, you won't actually get better entry points. Just like when people trade the RSI, they look at the RSI and they go, oh, we're in the overbought territory, let me sell. Actually, when we're in the overbought territory, that's when 90% of the gains are made. Human Being Lear says, that's true. I'm curious about the Wall Street. 1978, Buckley said, agreed, Dan, when markets crash, it's because something else is broken. The talks doomed already. Unfortunately, we're going to see some action in the Middle East again. That could be a big scare and bring the markets down. I'm trying to go through all the comments. Just because the S&P is high means it will hurt more people when the sell-off happens. Yeah, it just means more people will be in losses because everyone's winning. When the S&P 500 is at all-time highs, every single person that's ever bought the S&P 500 is in profit. So obviously when it crashes, more people will be in pain and there will be more emotions and more sell-offs. This is NVIDIA. Again, the world shakes again. Yes, NVIDIA is going to be massive. That's going to be that make or break moment. I see the market's completely different than someone with a full-time job, says Dan Ackerman. 1978, Buckley says, lol, me too. I can't tell Buckley. I can tell Buckley. Hume English says, same here. I see here. I see here self-employers. Good morning, Liz. Good afternoon. Being self-employed opens your eyes as things hit closer to home. Ricardo says VIX is climbing. We are cooked. Is the VIX going up? Oh God, here we go. VIX, VIX, VIX. Just type it in. Yeah, the VIX is up 5% today. Yeah, and again, I'm not calling for a crash tomorrow. I'm just a bit bearish on 2026. I think it's a year of opportunity. I'm not also calling for a big, massive recession, depression, like maybe some people are in the chat. I think that will come at some point, but it's very hard to predict those ones, and you can't just live your life always thinking that's going to happen next. If there's opportunity in the market, you have to take advantage of it, and if the depression comes, you just have to make your way through it. Um, Again, easier said than done. VIX is climbing. We are cooked. Let's talk about high egg prices. Lol, I haven't heard about them in a couple of days. Eggs. Can you give us chart analysis on SPY and the best prices to buy? Again, I don't know what the best prices to buy SPY are, but I know what I'm looking at when I look at the S&P 500. Is this, yeah, I've got this whole big parallel channel all the way since the downtrend of 2022, where we said, okay, the bear market's over. We've been tracking this parallel channel to the upside again. Is this because the charts are amazing, or is it just because it helps with buying entries? I think it's a bit of both. I wouldn't rely solely on charts, but I wouldn't trade without charts either. Anyway, this parallel channel, the big red lines to the upside, take away the indicators for a second, uh, are is levels I look at when the S&P 500 is in them or below them. I get excited. So for me, the S&P 500 maybe 6,300, 6,100, and then lower levels is where I get really excited, and I actively am pretty much fully deployed. 5,900, and at this point it'd be around 5,500 in the S&P 500. So from where we are right now, when would I start buying the S&P 500? At the heart line of the parallel channel, that'd be at 7% down. At the bottom of the parallel channel, that'd be 10% down. Below the parallel channel, it's 13% down. And then sort of once every few years opportunity, 20% down on the S&P 500. Again, will I get any of those levels, one of those levels? Who knows? But that's my thought. That's where I'd buy the S&P 500 right now. It's too overvalued, in my opinion. I'm just positioning myself to profit from this market. So if and when my business goes under, I'm not destitute. I like eggs, boiled, fried, scrambled, deviled, says 1978 Buckley. Dan Ackerman says, I am paying off as much debt as possible. Been positioning for the past year. Ricardo says, good morning, banana heads. Freaking out over the red market. Don't freak out. Just be prepared for it. 1978 Buckley. Again, I've always said, be prepared for the downside, the upside, and the sideways action. Martyn will be live in about one. Let me just check this. I'm in the land of development, scary stuff. I do all the bureaucratic red tape on the front and end before projects go vertical. Oh, let me listen to it. I'm in land development, scary stuff. I do all the bureaucratic red tape on the front and end before projects go vertical. Oh, interesting. Very interesting. Thank you for sharing that with us, 1978 Buckley. Casey Crypto says, very cool. Oh, Casey's with us today. How are you doing, Casey? 1978 Buckley says, very stressful. I can imagine. Oh, did we just get 5 memberships gifted? Why is it not playing a sound? Thank you so much, 1978 Buckley. 5 memberships gifted. Please do hit the like button and subscribe, and you can claim your free memberships. Crash today. Casey Crypto says, I bet it is. Ken Block says, Bitcoin going to 40K. I am buying XRP to 50p, says Ken Block. Casey says, good morning. Let me actually.
I can't believe this.
Let me change this. Thank you, 1978 Buckley. Guys, please do claim your memberships and thank 1978 Buckley. Ken Block says Bitcoin's going to 40K. I'm buying.
I can't
Yeah,
believe
I'm
this.
looking to buy. I'll buy Bitcoin at 40K, even though I don't love Bitcoin. I'll certainly buy at 40K. Crash today. I'm not predicting tomorrow we're going to crash. This could happen soon, but it can also happen in a few months, and it can also happen never. Um, Good morning, Yolanda. Andrew Webb says, thanks, Mr. Sensei. You're doing a great
I
job. Oh,
can't
thank you, Andrew
believe
Webb. Really
this.
appreciate it. AVVPD Gold. Yeah, if the markets crash, gold will probably also crash unless there's a geopolitical situation. Gold will go up. I do expect gold to have another attempt at all-time highs before it might top out. So gold, again, 4,700, 4,500 is buys for me. Silver, again, I do expect an
I
upturn,
can't
maybe a lower high,
believe
maybe a
this.
higher high. But I expect to go back to $100 for silver before collapsing further down. See you all later. Got to run. Bye, human being Liz. Lovely to see you. See you soon, Liz. Dan Ackerman says, 1917 Buckley. I am excavating, so we're in a similar businesses for sure. Lovely. Sup Discordian says Widgeto. Casey Crypto says, thank you. Thank Lady Buckley again. Good morning, says Jason. Good morning, everyone, says William Myers. We got through all the questions. And we are about to have Martyn on the show. So let me just go through a few charts quickly. Let's have a look at the market. Let me just have a look at this. We've got a few buys going into the market today in the portfolio challenge. Let me know in the chat if you are. Oh, Vocal Foster is in the newsletter. Oh, thank you, Vocal Foster. I got your message. I don't know if you're a premium member or not, but I can accept it and I'll have a look at it. Let me see if those buys have gone through. Today was the day we executed some buys in the healthcare industry. Have those buys gone through? Some of them have, some of them haven't, I guess. Let me have a look. Healthcare and value. Let's have a look. Let me go to the holdings. No, a lot of them haven't executed yet. I think it'll be on market open. AstraZeneca's gone through because of. Oh, I've just given away one of the holdings because it's in the UK market. Brilliant. Let me know. Has anyone else in the portfolio challenge that is watching the show right now? Did you guys see the? Oh, what have I done? Did you guys see the healthcare post? What do you think? Let me. What have I done? There we are. Thank you, Lady Buckley again. Thank Lady Buckley again. I'm just waiting to see if anyone else is in the portfolio challenge and has executed any buys. Well, I've seen the healthcare pie. I haven't got the link from Martyn, so what I'm going to do is I'm going to send everyone to the extra channel while I wait for that. So let me redirect this to the extra channel. And then Martyn will drop the link for his show in the extra channel. Let me do that now. NASDAQ may copy the Fed March 2025 crash. Interesting. Oh, Yolanda's seen it. Yolanda says yes. What do you think of the healthcare? Is that something you're interested in, Yolanda? Let me. There we go. Okay, that's safe now. Dan, can you do some excavating for one of my remeditation jobs? The amount of filling dirt is ungodly. We've got two people working together now in the chat. Bloody hell, Martyn looks younger. No, Chris, my name's Sensei. I do the morning forecast shows. I do the charts. I do the crypto. I've got the portfolio challenge. I run the newsletter. So Martyn will be on later. Anyway, thank you, Yolanda, for answering. What I'm going to do now is everyone's going to go to the extra channel. Oh, wait, actually, no. Sorry, I've just got a message from Martyn. I apologize for the confusion this morning. Martyn says 1 minute. So I think we're going to get his actual show. on. I think we're going to get the link for the actual show. Bear with me. Apologize, everyone. I would stay, but I have to head out the house about now. Let's have a quick another look at the markets. Bloody hell, Martyn looks younger. S&P 500 dropping 0.5%. I'm not too interested in the market right now. There's nothing really that's screaming buys to me again. Crypto's had its bounce. We took our 50% profit on XRP. Again, not too much of an opportunity there right now. We've got some buys in Bitcoin at 68,000. Nothing's looking too tempting. Silver's probably looking the most tempting. Again, I'm building the base of the portfolio of healthcare and stuff like that. Healthcare utilities, consumer staples, copper, silver. Time to touch grass. What does that mean? AVVFD. What does that mean, time to touch grass? Done it. Time to touch grass? What does that mean? Maybe I don't know the saying. Okay, brilliant. We've got the link from Martyn. So I'm going to end the show. Thank you everyone for tuning in. If you stay exactly where you are, you're going to go straight to Martyn's show. Until next time, I'll see you later. There's going to be some videos premiering from today. So if you missed the beginning of this video about the AI bubble, there'll be 2 videos that will come out later. And then I might do an XRP show later as well. But until next time, there's links in the live chat. If you stay here, you'll go straight to Martyn's Morning Bell show. Until next time, take care of yourselves and each other. Bye-bye.